Well, let's be clear. If we're recession hunting, we haven't been doing it in the credit market through the month of January, Rick. High yield just had a massive month.
It's incredible. Yeah, no, I mean, you think about how much it came off in December, but then the bounce back. I mean, the demand for income in the world, and once you hit levels where the carry was really attractive, the demand globally that's come in for the sector has been extraordinary. And by the way, some of the story that people have been espousing about the investment grade credit market is going to blow up the world, and this triple B. By the way, there's truth to leverage growing.
Yeah.
It was a bit overstated, and I think that's why you've seen this immense bid that's come back into the market.
Well, let's talk about the bid that has come back into the market, and actually the reality that investment grade hasn't participated in the rebound in the same way, say, high yield has. Why?
So I'd say a couple of things. First of all, on a beta adjusted basis, investment grade has had a pretty good
right.
run. But there's a sheer your ability to hit these yield targets, and particularly if you're overseas and you have the cost of the cross currency basis. But these yield targets for that asset class, for parts of the securitized asset class, if you can get, by the way, parts of emerging markets, if you can get, or certainly local rates, if you can get 6 to 8. And think about where the go forward growth is. If I can get 6 to 8 in a fixed income asset, that's a pretty attractive number. And your carry, you can take 3% defaults if I'm getting 8 or if I'm getting 7. And if we've been running at 2% or less defaults, if it accelerates a little bit, that carry works now.
Mike?
Yeah, I mean, the reach for yield is back in vogue, right? And I think it's driven partly by external forces, right? Again, going back to yields outside the U.S., right? And it feels like the Bank of Japan and the ECB are stuck at zero forever, right? And once you realize that rates are going to stay low, and even in the U.S., right, I think there's a realization setting in that rates are going to stay in the 2s on treasuries, people need income, and they will buy anything with yield. And we're actually seeing a big bidding war in Europe for bonds. You cannot buy a corporate or high yield bond in Europe right now. They are, there's no offers out there. So you're seeing that spread compression happen, and that could continue for a while.
Oksana?
On investment grade specifically, so this sort of, as you mentioned, it hasn't participated as much, and that's been investment grade wide, including some of the floating rate parts of that market. And speaking of income, there are some very interesting opportunities right now to pick up, 4% yielding floating rate issuance there that has kind of suffered along with the rest of the market because of repatriation last year, because it's not necessarily the floating rate portion of that market is not in index position, and so you don't have kind of a constant natural buyer. And so you can pick up names that are A- type credit, with average maturity of 2 years or so, essentially floating rate with a 4% yield, and that's a great place to be.
Just in terms of the performance in high yield, the primary market reopened. We had a big freeze in December. We reopened. Those issues did really well in the secondary market as well. Rick, was that a function of the fact that many people were just starved of supply through much of 2018? Or is it an indicator of how solid the economy and fundamentals are?
So I think, by the way, when you go back to your earnings, I think it's pretty interesting. You now have, which we didn't have 2-3 years ago, we now have a bit of a mixed picture. You're seeing some beats, some. It's really different in the last 3 years. If you're investing in credit, you're investing in high yield, it means you're going to have higher defaults. Some companies that have geared their portfolio, their balance sheet, you're going to get more defaults. It's just not going to cut it in this cycle. And that is a big deal. But you think about people de-risked into December, and then all of a sudden, I got to get the risk back on. And by the way, there's something that people underestimate. If the Fed is symmetric or the Fed is sensitive to the economy, all of a sudden duration works, all of a sudden the dollar works as a hedge, the dollar. All of a sudden you could build a balanced portfolio that you couldn't last year. You had to just hide in the front end of the yield curve and just don't cash because everything's going down. Now all of a sudden, boy, you can have some duration, you can have the dollar's not going to hurt you. It's a really different dynamic for taking risks.